Welcome to The Explainer. Today we're diving into the sudden, absolutely brutal sell-off in precious metals that left pretty much every investor asking the same question. What on earth just happened?
I mean, just look at this. In one single, incredibly volatile session, silver prices just plummeted. We're talking by as much as 30%. And gold, the traditional safe haven, well, it wasn't safe either. It dropped a staggering 15%.
A move like this sent a massive shockwave through the markets. It really forced everyone to question the very definition of a safe asset. So to understand what happened, we need to rewind the clock a little.
You see, before the crash, the mood in the market was, well, it was euphoric. So to really understand the fall, we first have to understand the incredible rally that came right before it. There was this incredibly powerful narrative that had basically convinced investors that gold and silver had nowhere to go but up. And on paper, the bullish case looked undeniable. I mean, you had a structural supply deficit that had been going on for 5 years. Central banks all over the world were stockpiling reserves. And with growing global uncertainty, investors were naturally running towards traditional hedges. To top it all off, a big shift towards looser monetary policy made the whole argument feel absolutely rock solid. And the demand was so intense that these huge price gaps, or what they call dislocations, started appearing between markets in the East and the West. That's a huge sign, right? It showed that buyers were willing to pay a massive premium just to get their hands on physical metal. So with all that momentum, what could possibly stop the rally? Well, it turns out it wasn't just one single thing, but a perfect storm of powerful macroeconomic triggers all hitting at once. It all happened at the same time. First, a stronger US dollar suddenly made these metals way more expensive for foreign buyers, which cooled off demand. At the same time, rising bond yields created a much more attractive alternative for investors' cash. And then, the final piece. Increasingly hawkish talk from central banks, signaling that the whole era of easy money, a key driver of the rally, might be coming to an end. And this brings us right to the concept of opportunity cost. All of a sudden, big institutional players had to stop and ask themselves, why hold a metal that pays me nothing when I can get a solid, guaranteed return from a government bond? For many of them, that calculation changed almost overnight. But here's the thing. Those triggers, they explain a price drop, maybe a correction, but they don't explain a full-blown crash. To understand the sheer speed and severity of this collapse, we really need to talk about leverage. As Zerodha CEO Nithin Kamath pointed out, a lot of traders weren't just betting on the rally. They were using borrowed money or leverage to amplify their bets. And sure, that makes your gains much bigger, but it also makes your losses absolutely catastrophic. So this leverage created an incredibly fragile situation, with the entire rally basically balanced on a knife's edge. And when the price began to dip, even just a little, that's when the first domino fell. Automated sell orders, or stop losses, which traders preset to limit their losses, they just started to trigger all at once. So you've got this first wave of selling, and then it gets detected by high-speed algorithmic trading systems. And these things are just programmed to follow momentum. So they piled on, creating this absolute waterfall of sell orders that just accelerated the fall way beyond what the fundamentals would ever suggest. So the crucial point here is this. The unwinding of all these crowded, leveraged positions is exactly what turned a simple correction into a brutal, cascading crash. It was a chain reaction, and it was fueled by debt. In the aftermath, this whole crash has left the investment community at a real crossroads, deeply divided on what to do next. On one side, you have this deep pessimism, this feeling that no asset is safe and there's really nowhere to hide. But on the other side, you've got the long-term optimists who see any major dip like this as a buying opportunity, a chance to accumulate assets at a discount. Which leaves all of us with the central question this event has forced every investor to reconsider. In a world of extreme volatility and automated leverage, does the very idea of a safe haven asset still exist? That's the question now echoing through the entire market.